Huh? We just calculating cash flows from investing activities. Please remember, cash flow from investing activities, we only look at financial assets as well as tangible assets, okay? With respect to your tangible assets, guys, in the income statement, the only thing that you need from the income statement is depreciation, as per the table that I showed you in the previous slide. You need depreciation for you to be able to calculate the cost of an asset, especially if that asset is depreciated. Okay. You also need the statement of financial position, but in the statement of financial position, all you need is simply fixed assets. All right. You realize that for our fixed assets, we have land and buildings. Guys, remember, we are all about the cash flow. All right. Whether money is coming in or money is going out. In this case, guys, we are simply checking whether from our investment will money be coming in, or are we investing more money. All right, when we invest more money, that will result in a cash outflow. Hope that makes sense, right? Guys, for land and building, when it comes to land and building, for you to determine whether investments in land and building have resulted in a cash inflow or outflow, you just have to compare the 2 years. All right, if if your land and building has gone up, it means that you bought land or you expanded, all right, or you bought more buildings. So basically, that will result in a cash outflow. If it has decreased when you compare this year and last year, it means that you sold. You realize that for 2016, our land and building is 6,100,000, and for 2015, our land and building is 4,220,000. So basically, guys, with respect to land and building, we don't need depreciation from the income statement because land and building does not depreciate. Land and buildings does not depreciate. Obviously, when you go to varsity, you'll be taught something pretty much different. Okay, in essence, land, it doesn't depreciate. However, certain buildings can. Right, but for now, guys, for grade 12, they do not depreciate. Okay, they only appreciate in value, and that you will do it at varsity. We normally refer to it as revaluation allowance. But for now, you don't need to know all of that, guys. Land and building does not depreciate. In this case, guys, we don't need to know depreciation. And land and building, as you know, as per the accounting principle, it will always be measured at cost price because it doesn't depreciate, and it remains at cost price. So you don't need to know the carrying value. You will never be given the carrying value of land and buildings. Now, in this case, guys, our buildings, land and buildings, has gone up. If I take 6,100,000 and I minus 4,220,000, I get 1,880,000. It means that we bought more land or buildings, or we expanded our buildings. So basically, in this case, guys, we lost money worth 1,880,000. Okay, I haven't even started with the calculations yet, but you can actually tell that in this case, guys, for your land and buildings, it has increased, meaning that it resulted in a cash outflow. Shortly, I will be discussing equipment. Equipment is depreciated, and you realize that in this case, guys, we are simply given the carrying value of equipment, which makes things difficult because we can't just take this year and minus last year like we normally do, and probably there are disposals that took place during the year. Okay, if it's at cost, it was going to be a little bit easier, but now it is at carrying value, which makes things a little bit tricky. We will discuss that in a moment.